నమస్కారం. డాక్టర్ బిఆర్ అంబేద్కర్ సార్వత్రిక విశ్వవిద్యాలయ విద్యార్థులకు స్వాగతం.
Hello students, today we are going to discuss about the topic accounting principles from Financial Accounting 1. Before we learn about the accounting principles, let us understand the term accounting. Accounting is the process of identifying, recording, classifying, analyzing and summarizing the business transactions of an organization. Here we should not be confused with the term accountancy. Accountancy is the body of knowledge. It's a body of knowledge about the accounting. Now, what is the objective with which the accounting records are prepared? What for we prepare the accounting records? Now, we have two objectives of preparing the accounting records. Number one, to know the net result of business operations, that is, through the preparation of the income statement or the profit and loss account. To know the financial position of a company on a given point of time. For the accounting period, to know the business results, we prepare income statement. To know the financial position, we prepare balance sheet. This is the objective with which we prepare the financial accounting records. Now, the system of accounting has two main ways of entering business transactions. Number one, single entry system, where the transaction has only one effect, either debit effect or the credit effect. Only one effect is recorded in the books of accounts. Whereas in the double entry system, dual effect is considered. That is, if a transaction takes place in a business organization, this transaction has two effects. There is a benefit giver or sacrificing entity, and there is a benefit receiver or beneficiary. So, these two entities are affected. In our language, the two accounts are affected for any given transaction. So, under double entry system, we recognize both debit and credit while we record the business transactions. Now, the accounting principles, when we look into, they are the guiding principles, guiding statements. Now, the Accounting Standards Board, which is the subsidiary or the part of the Institute of Chartered Accountants of India. The Accounting Standards Board, which is part of ICAI, is responsible for framing the accounting standards in India. Now, let us look at the accounting principles. Now, accounting principles can be divided into two categories: accounting concepts, accounting conventions. Now, the accounting concepts are those things which are necessary upon which the accounting is based. It is a term used to connote accounting postulate, and these accounting concepts are business entity concept, money measurement concept, cost concept, going concern concept, dual aspect concept, realization concept, matching concept, accounting period concept, accrual concept. And let us look into the details of these concepts. Now, business entity concept. Business is treated as separate entity from its owner. The owner and business are separated according to this concept. All the transactions of the business are recorded in the books of accounts from the point of view that the business is treated separate from the owner along with the creditor. Now, the second one is money measurement concept. In accounting, we record only those transactions which are expressed in terms of money, which means a fact which cannot be expressed in monetary terms cannot be recorded in the books of accounts. Only that which can be converted into monetary units can be recorded in the books of accounts. Now, the next one is accounting period concept. In accounting, life of the business is perpetual. We set up business with a purpose that it should run into perpetuity, that is, forever. But still, it has to report the results of activity undertaken during a particular period of time. This particular period of time can be a week, can be a month, or can be a year. Now, in India, we follow the accounting period as 12 months, starting from 1st April of the current year till the 31st March of the next year. So, this is 12 month span. Now, the accounting period here, it is considered as 12 months, that is 1 year. Now, let us come to the cost concept. Transactions are entered in the books of accounts at the amount actually involved. We do not consider the inflation, we do not consider the deflation, the increase or decrease in the value of the materials or the assets we do not consider. For example, if a company purchases a car for 150,000, the real value which is 200,000, the purchase will be recorded as 150,000 or 1,50,000, not 2 lakhs. Whatever be the value in the market, we record with which we have purchased the transaction, we have purchased the asset. And this is one of the most important concepts, and it prevents arbitrary values being put on the transaction, fiduciary values put on the transactions. Now, going concern concept is another concept we are going to look at. It is under the premise that the business will exist into perpetuity, as we have discussed, and the transactions are recorded from this viewpoint. The entity is assumed to remain in operation as long as possible till it is wound up by the operation of the law. That means the business entity is set up for a long term to accomplish its long term objectives. The time duration is long enough to accomplish the objectives and the mission of the organization. Now, we look at the dual aspect concept. Now, each transaction has two aspects, as we discussed initially: the debit and the credit, the sacrificer and the beneficiary. The receiving entity will be debited and the beneficiary will be credited. This is a principle which is core in the entire accounting process. Now, for example, the proprietor of a business starts his business with cash of 1 lakh. Machinery worth 50,000 is bought and the building worth 30,000 is constructed. Then this fact is recorded in two places, that is, assets account and the capital accounts. The capital of the business is equal to the assets of the business. Now, look at this. The capital plus liabilities is equal to assets. The capital plus liabilities is equal to assets. We procure the assets with the finances raised through capital and through liability. The capital is the amount contributed by the owner or the promoter or the investor. The liability is the external borrowing from the financial institutions or the banks or an individual. So, with the help of capital and the external borrowing, we procure the assets. So, therefore, the dual entity concept gives us an equation: capital plus liabilities is equal to assets, or capital is equal to assets minus liabilities. If you deduct the value of the external borrowings from the assets, you will get the value of the capital. Now, this is known as accounting equation. Capital plus liabilities is equal to assets. Capital is equal to assets minus liabilities. This is accounting equation. Now, let us come to the realization concept. This concept emphasizes that profit should be considered only when realized. Accounting should be taking into consideration profits only when the same have been realized. Unless they are realized, we cannot record in the books of accounts. What we cannot realize can never enter into the books of accounts. Now let's come to the matching concept. Matching concept requires that expenses should be matched to the revenues of the appropriate accounting period. Now we have discussed about accounting period. The accounting period generally is for 12 months. Now for the 12 months you had to match all the expenses against the revenue. What for? Now we have two objectives. To know the net result of the business operations, we prepare income statement. To know the financial position, we prepare balance sheet. Now here we match in the income statements all the expenses against the incomes, so that we come to know what is the value of the profit or the loss, that is net loss or the net profit, net income or the net loss. Now we must determine the value of revenue earned during a particular accounting period and the expenses incurred, and the resulting the net difference is either profit or loss. Now let us come to the accrual concept. Accrual is concerned with the expected future cash receipts or payments. Now accrual is simply it is becoming due. Accounting attempts to recognize non-cash events and circumstances as they occur, that is, whether received or paid. Once it becomes due, we recognize that event, we recognize that business transaction and report into the books of accounts. For example, purchase and sale of goods on credit and wages and salaries outstanding. Now we have not paid the salaries, we have not paid the wages, it is still outstanding, but still we treat it as if it is paid. So once it becomes due, it is an obligation, so therefore it is an expense. Now we have sold the goods, still we have not received the cash, still we treat it as sales revenue and account for it. So the accrual concept says whether it is received or not, whether it is paid or not, once it becomes due, we will record in the books of accounts. Now let us look into the stable monetary unit. The concept presumes that the purchasing power of monetary unit, say rupee, remains the same, it remains the same throughout, thus ignoring the effect of rising or falling purchasing prices, that is, inflationary situations are not taken into consideration. We understand that the price, the value of rupee, the value of dollar remains the same. Now let us look into, now we have seen the accounting concepts. Now let us look into the accounting conventions. The term convention is used to signify the customs and traditions as a guide to the presentation of the accounting statements. Now, in order to enable the management to draw important conclusions regarding the working of a company over a few years, it is essential that accounting practices and methods remain unchanged from one accounting period to another accounting period. So, the comparison of one accounting period with that of another is possible only when the convention of consistency is followed. So, what we understand is the convention of consistency is the first convention of consistency. For example, if we are following the straight line method of depreciation in 1 year, the next year also we had to follow the same methodology. In 1 year straight line method of depreciation, in another year diminishing value of depreciation we cannot go with, because the values arriving out of those physical assets or the fixed assets will be changing. Now the comparison is unrealistic. So therefore, whatever method we are using in a particular period of time, the same has to be followed in the successive period of time, if at all, if the business entrepreneurs are to compare the figures of the previous and the current year. Now let us look into another convention, that is disclosure. This principle implies that the accounts must be honestly prepared and all material information must be disclosed therein. The content of balance sheet and profit and loss account are prescribed by the law. The schedules in the balance sheet, the schedules in the income statement or profit and loss accounts are given by the Companies Act. Now these things are to be disclosed, every information. Now one thing to be noted is the information of the financial accounting is to be disclosed to all the parties interested in the company, that is the stakeholders. And these disclosures measures are designed to make disclosure of all material facts compulsorily, and this is given by the Securities Exchange Board of India in our country. Now let us come to the convention of conservatism. Now financial statements are always drawn up on a rather conservative basis, that is, anticipate the future losses but do not anticipate the future gains. If the gains come, we record but do not anticipate, but we have to anticipate the future losses. That is the conservatism convention. It shows the position better than what it is. Now it is also not proper to show a position worse than what it is. You cannot show a position better than what it is. Actually, you cannot show a position worse than what it is. In other words, secret reserves are not permitted or allowed. Now with this, we have completed all the concepts and conventions which we call the accounting principles. Now these accounting principles are different from country to country, from context to context, from situation to situation, based on the circumstances. Each country, through the enactments, through promulgation in their respective parliaments, they have formulated their own rules and regulations of accounting. Now these accounting principles generally in some countries are known as generally accepted accounting principles. Now all the accounting concepts and accounting conventions are followed while we are making the business transactions reports. The financial statements, like the income statements and the balance sheets, are prepared in light of these accounting concepts and conventions. Now we have completed the accounting concepts and conventions. Now these accounting concepts and conventions put together, we call it as accounting principles. These accounting principles are generally known as generally accepted accounting principles, GAAP. Now when we look at the objectives of accounting, we prepare the accounting records for two purposes, that is, to know the result of business operations and to know the financial position of the company. Generally, human activities are of two types, that is, economic activities and non-economic activities. We do not record any non-economic activity in the books of accounts. All the economic activities pertaining to the business organizations are recorded in the books of accounts. We record the business transactions under two categories. One is personal account and second one is impersonal account. The impersonal account is again subdivided into nominal account and the real account. The personal account is related to the person. The person can be legal person like a company, like a society, like an organization, charitable organization. The person can be legal person like that, and the person can be natural person, an individual. So the accounts related to these two types of persons, natural as well as legal persons, when we maintain accounts for these two types of persons, we call those accounts as personal accounts. Now in personal accounts, the rule is we always debit the receiver and credit the giver. We always debit the receiver and credit the giver. Now under the impersonal accounts, let us look at the nominal account. Under the nominal account, all expenses and losses are debited and all incomes and gains are credited. Now let us look at the real account. All liabilities are credited and all assets are debited. Now if you look at only the assets account, now debit what comes in and credit what goes out. Whenever you purchase or procure an asset, you have to debit the asset account. If it is machinery, we have to debit the machinery account, and whenever there is sale of machinery, you have to credit that particular machinery account. Now likewise, when we look at the liabilities account has to be credited. Now whenever there is an income coming, there is a flow of finances into the company, we credit, and whenever there is a withdrawal of the capital from the company, and there will be a debit. Now we have to understand the personal accounts can be debit or credit, but when we look at the asset account always shows debit balance. The liabilities account always shows credit balance. The expenses account always show debit balance. The loss account always show debit balance. The income account always show credit balance. The gain account always show credit balance. So in light of this, let us look into the accounting principles. Now accounting principles are the postulates or the conventions. Now postulates are the concepts and the conventions are the practices prevalent in the business organization. Now the convention is not mandatory, it is a practice, but the concept is mandatory, it is compulsorily which you have to abide by. So both concepts and conventions put together is accounting principles. So we are going to deal with accounting principles in detail one by one, starting with the accounting business entity concept and money measurement concept, accounting period concept, cost concept, going concern concept, dual aspect concept, and realization concept, matching concept, accrual concept, and followed by the accounting convention. Now to conclude, I would like to reiterate, in India, the Accounting Standards Board is responsible for making these standards. Thank you.
మా కార్యక్రమాలపై మీ సూచనలు సలహాలు తెలియచేయండి. మీ సూచనలు సలహాలు తెలియచేయవలసిన మా చిరునామా: డైరెక్టర్, ఆడియో విజువల్ ప్రొడక్షన్ అండ్ రీసెర్చ్ సెంటర్, డాక్టర్ బిఆర్ అంబేద్కర్ ఓపెన్ యూనివర్సిటీ, ప్రొఫెసర్ జి రామరెడ్డి మార్గ్, రోడ్ నంబర్ 46, జూబ్లీ హిల్స్, హైదరాబాద్ 500033.